Did you know that Americans collectively owe over $1 trillion in credit card debt? It's a staggering number, but what does it really mean for you? In today's video, we'll explore the multifaceted world of credit cards, the good, the bad, and the downright ugly. From earning rewards that make life a little sweeter to the high interest rates that can turn them sour, we'll dissect how these little pieces of plastic can impact your financial health and decision-making processes. We'll also uncover some of the less discussed dangers that lurk behind the convenience they offer. This analysis is based on data from trusted financial institutions, insights from consumer protection agencies, and the latest studies in financial behavior. With meticulous research and factual accuracy, we aim to equip you with the knowledge to use credit cards wisely and avoid common pitfalls. The good, rewards, and benefits. Credit cards aren't just tools for spending. They can also be instruments of saving if used wisely. The rewards system is one of the primary attractions of credit cards, offering users cash back, points for travel, or other merchandise through their spending. For instance, cashback cards typically return a percentage of the amount spent back to the user. These can range from general 1% to 2% cashback on all purchases to higher percentages in specific categories like groceries or fuel. Travel cards, on the other hand, convert spending into points that can be redeemed for airline tickets, hotel stays, or car rentals, often accompanied by travel-specific perks like free access to airport lounges or travel insurance. There are also cards that cater to specific interests, such as those offering rewards on dining and entertainment. It's crucial to choose a card whose rewards align with your spending habits and lifestyle to maximize benefits without increasing unnecessary spending. Building credit. A major advantage of using a credit card is the opportunity to build or repair one's credit score. Every time you make a payment on time, it positively impacts your credit history, which is crucial for future financial activities like securing loans with favorable terms. To effectively build credit, maintain a low credit utilization ratio. This means using less than 30% of your credit limit and paying the balance in full each month to avoid interest charges. Setting up automatic payments can help ensure you never miss a due date. Furthermore, keeping older credit cards open can benefit your credit score by lengthening your credit history, provided they don't carry high fees that outweigh the benefits. Convenience and protection. Beyond financial benefits, credit cards offer unmatched convenience and security features. They are widely accepted globally, providing a hassle-free way to handle transactions abroad without the need to carry large amounts of cash. In terms of protection, most credit cards come with built-in fraud protection that limits your liability for unauthorized transactions. Additionally, many offer benefits like extended warranties, return protection, and purchase protection, which can cover items bought that might be lost, stolen, or damaged shortly after purchase. Chargebacks are another significant advantage, offering you the ability to dispute a charge and get your money back if a product isn't delivered as described. This layer of security and the ability to track spending digitally makes credit cards a powerful tool in managing personal finances securely. The bad. High interest rates. One of the most significant drawbacks of credit cards is their high interest rates, particularly when balances are carried over from month to month. Interest is typically calculated based on the annual percentage rate, APR, which can vary widely depending on the card issuer and the user's credit score. For example, if a credit card has an APR of 20% and you carry a balance of $1,000, the interest calculated monthly would be about $16.67. This doesn't sound like much, but compounded over time, the cost escalates. If you only make minimum payments, this interest compounds, meaning you're paying interest on the interest previously accrued. This can dramatically increase the total amount you owe and the time it takes to pay off your debt. A $1,000 balance could take years to pay off with minimum payments, costing much more than the original amount charged due to compound interest. Understanding these implications is crucial to managing credit effectively and avoiding the debt spiral that can occur with high-interest credit cards. Hidden fees. Credit cards often come with a variety of fees that can catch users by surprise if they're not careful. Common fees include annual fees, late payment fees, balance transfer fees, and foreign transaction fees. For example, annual fees can range from $50 to several $100s, depending on the card's rewards program and benefits. Late payment fees not only result in a financial penalty, but can also damage your credit score if the payment is significantly late. Balance transfer fees are charged when you move a balance from one card to another, typically 3% to 5% of the transferred amount. Foreign transaction fees usually amount to about 1% to 3% of each transaction made abroad. To avoid these fees, it's essential to read and understand your credit card agreement carefully. Opt for cards with no annual fees, set up payment reminders to avoid late fees, and use a credit card specifically designed for travel if you frequently make purchases in foreign currencies. Potential for debt. The convenience and purchasing power of credit cards can sometimes lead to unintended financial strain. In the U.S., it's estimated that the average household with revolving credit card debt owes approximately $6,270. This debt often accumulates due to spending beyond one's means and not paying off balances each month. Anecdotal evidence suggests that unexpected expenses, such as medical bills or car repairs, can rapidly escalate into substantial debt when charged to high-interest credit cards. The psychological ease of swiping a card rather than parting with cash can also contribute to this problem. It's crucial for users to monitor their spending habits, budget effectively, and ensure they can pay off their balances each month to avoid the pitfalls of credit card debt. The ugly impact on mental health. The psychological impact of credit card debt is profound and well documented by numerous studies. Researchers have found a significant correlation between high levels of unsecured debt, such as credit card debt, and increased stress, anxiety, and depression. The constant worry over meeting payment deadlines and managing accumulating interest can lead to chronic stress, which in turn deteriorates one's mental health. Furthermore, this stress can exacerbate feelings of low self-esteem and helplessness, particularly when individuals feel trapped by their financial situations. For many, the shame and stigma associated with debt prevent them from seeking help, thus perpetuating a cycle of mental distress. It's essential for those struggling with debt to recognize these potential psychological effects and consider seeking financial counseling or mental health support to manage both their finances and well-being effectively. Credit score damage. Mismanagement of credit cards can have long-lasting negative effects on your credit score, a crucial metric used by lenders to assess creditworthiness. Missed payments, high credit utilization rates, i.e., using a large portion of your available credit limit, and applying for numerous credit cards within a short period are common mistakes that can significantly lower your score. Each missed payment can reduce your credit score by a substantial number of points, and such marks remain on credit reports for up to 7 years. A low credit score affects your ability to secure favorable terms on loans, such as mortgages and auto loans, and can result in higher interest rates, which further compounds financial strain. Managing your credit card usage wisely by making payments on time, keeping balances low, and only opening new cards as needed can help protect and improve your credit score. Credit card issuers often employ aggressive marketing tactics that can lure consumers into unfavorable terms and debt. Predatory practices include hiding significant terms in fine print, offering unsustainably low teaser interest rates that balloon after an introductory period, and targeting vulnerable populations who may not have the financial literacy to understand the implications fully. For example, some companies aggressively push add-ons like credit insurance, which can be costly and unnecessary for most consumers. To avoid falling prey to such tactics, it is vital to thoroughly read and understand all credit card agreements before signing. Additionally, consumers should be wary of offers that seem too good to be true, such as those promising guaranteed approval, regardless of credit history. Educating oneself about common predatory practices and remaining vigilant can help avoid the pitfalls of unethical credit card marketing. Credit cards are powerful tools that can enhance your financial flexibility and security when used responsibly. They offer significant advantages, but also require careful management to avoid financial pitfalls. What's your experience with credit cards? Have you found them more beneficial or burdensome? Share your stories and tips in the comments below. Your insights could help others navigate their credit card use more wisely. Don't forget to subscribe and hit the like button if you found this video helpful. Turn on notifications to stay updated with our latest content, and keep the conversation going by commenting your thoughts and questions below. Your engagement helps us grow and improve our content.